Imagine looking at a business that just lost over $20 million in 90 days.
Right, just a massive, massive hit.
Yeah. And not only that, but a foreign government suddenly decides to tax 45% of their product at the border. Plus, their main customer base is basically entirely frozen by, 6% interest rates.
Which is just a brutal combination.
It's wild. On paper, you are looking at a completely dying company. But if you actually read between the lines of this latest release, the Q1 2026 earnings report, and that May 6th conference call for GreenFirst Forest Products, you're actually looking at a masterclass in extreme corporate survival.
You really are. And, when you sit down with a stack of financial documents for a Canadian lumber company, you kind of expect a really dry read.
Oh, yeah. Spreadsheets, corporate jargon.
Exactly. Updates on how many 2x4s they sold this quarter. But decoding this specific quarter, it actually reveals a pretty thrilling, high-stakes story for you listening.
Okay, so let's unpack this. Because this single lumber company is like a perfect microcosm of how ordinary businesses right now are navigating just a brutal gauntlet. I mean, extreme weather, international trade wars, global geopolitical conflicts. It's totally nuts.
It's all connected, and we're going to break down exactly how they're navigating this gauntlet for you. We'll start with, the raw financial hit they took, then move into the physical and political roadblocks they're fighting, and finally, uncover the surprisingly radical ways they are completely pivoting their business model.
Just to keep the lights on.
Just to survive.
Yeah. Okay, so before we zoom out to the global forces, let's look at the immediate reality happening right on the ground and, well, on the balance sheet. So GreenFirst posted a net loss of $20.7 million for the first quarter of 2026.
Right, and that translates to a loss of 89 cents per share. With their net sales dropping, I think it was 21% from the previous quarter, down to about $60.6 million.
And the cost of sales was remarkably high here. The documents specifically call out a $1.8 million adjustment on their inventory value, which, if you don't read financial reports every day, that sounds like, I don't know, a minor accounting quirk.
Sure, it sounds like jargon.
Yeah. What does that actually mean in plain English?
Okay, think of it like running a bakery. If your ovens are only running half the day, your rent and your electricity bills are still the exact same.
Right, your fixed costs.
Exactly. But you have fewer loaves of bread to spread those fixed costs across, so the cost to bake each individual loaf actually goes up. GreenFirst had to do this $1.8 million adjustment because their unit costs spiked when their mills just couldn't run at full capacity.
And they couldn't run at capacity because of massive physical roadblocks. I mean, they had to implement temporary mill curtailments in January. And the brutal winter weather severely disrupted logistics and shipments across Canada and the northeastern U.S.
Oh, absolutely. The supply chain literally froze.
You can't move trucks on roads that are buried in snow or washed out.
No, you can't. But that weather actually created a really bizarre paradox for them.
Wait, how so?
Well, that exact same freezing temperature that caused all of those logistical nightmares for shipping the finished lumber, it actually provided a massive advantage on the front end of their business.
Oh, the frozen ground.
Yes. The frozen ground in the forests allowed their really heavy harvesting equipment to operate flawlessly.
Because they're not getting bogged down.
Right, without trucks getting stuck in the mud. So now they are sitting on this fantastic, massive fiber supply that's ready for the rest of 2026.
Okay, so it's kind of like a farmer praying for rain for their crops, but, when it finally pours, it washes out the only road to the farmer's market.
That is a perfect analogy.
The weather giveth and the weather taketh away.
Yeah, and what's fascinating here is how these physical, weather-driven constraints can completely mask the underlying operational improvements on a balance sheet.
Oh, for sure.
Because looking at that $20.7 million loss, you'd probably assume the internal operations were just failing. But right in the middle of these losses, they achieved a massive operational victory, totally under the radar.
You're talking about the new Chapleau large log line.
Exactly. They installed this brand new saw line in their Chapleau mill, and the transcript notes it passed all its performance testing right at the end of the first quarter.
And it's already ramping up to over 90% of its expected capacity.
Yeah, 90%. Plus, they expect the entire project to actually come in under budget, which is rare.
That's huge. And it's not just making wood faster, it's making better wood. Like, they specifically noted it's producing better quality lumber with higher grades and less trim loss.
So functionally, the company is structurally coiled like a spring right now. The current balance sheet looks bleak. mostly because the finished product just couldn't physically move through the snow.
Right.
But internally, they are highly efficient and fully stocked with raw materials.
Okay, so they've solved the internal problem. They've got the shiny new Chapleau mill cutting perfect wood, and they've got logs stacked high. But, and here's the catch-all of that internal efficiency, hits an absolute brick wall the second they try to put that wood on a truck and cross the U.S. border.
Yeah, the border.
So let's talk about the tariffs.
This is where the macroeconomic reality really hits GreenFirst hard. Historically, this company does about 80% of its business with the United States.
80%. That is massive.
They rely heavily on the U.S. market, but currently, the tariffs and duties imposed by the U.S. on Canadian softwood lumber are just staggering.
Yeah, looking at the report, it states they're dealing with elevated U.S. duties around 35.16%. But then, because of the implementation of Section 232 tariffs, that combined rate actually spiked up to 45.16%.
It's an incredible hurdle.
Wait a minute, though. Why is the U.S. slapping a 45% tax on Canadian wood in the first place? What's the root cause here?
Well, it goes back to a decades-old trade dispute. Fundamentally, it's about how the two countries manage their forests. In the U.S., most timber is harvested from privately owned land, right? So the price of that timber is set by the open market.
Okay, makes sense.
But in Canada, the vast majority of timber comes from Crown land, basically land owned by the provincial government.
Oh, I see. So the Canadian government sets the price for the trees.
Exactly. The provinces charge what's called a stumpage fee to logging companies, and the U.S. lumber industry has argued for years and years that these government-set stumpage fees are artificially low.
Basically acting as an unfair government subsidy for the Canadian lumber companies.
Right. So to level the playing field, the U.S. imposes countervailing and anti-dumping duties.
And then we throw Section 232 on top of all that.
Right. Section 232 is a U.S. trade law that allows the president to impose tariffs based on national security concerns. So when you combine the ongoing softwood lumber dispute duties with these broader 232 tariffs...
Boom. GreenFirst is suddenly looking at that 45.16% penalty.
It's painful.
I mean, imagine trying to run a business where an international border instantly eats 45% of your product's value in taxes.
Yeah.
It is a historically brutal burden for an industry that typically operates on pretty tight margins anyway.
Extremely tight margins.
Now, during the earnings call, analysts did ask about rumors that duties might decrease to around 25% by October of 2026. But the leadership's reaction was pretty intense, wasn't it?
Oh, they were adamant. They said that even at 25%, that rate remains historically elevated. Their president actually explicitly stated to the Canadian government regarding any new trade agreements, he said, no deal is better than a bad deal.
Wow.
Yeah. They're flat out refusing to just accept an incredibly punitive framework just to get the dispute over with.
But I mean, if 80% of your customers are in the U.S., you can't just ignore the border. And you definitely can't force the U.S. buyers to absorb a 45% price hike. They'll just go buy wood from somewhere else.
Exactly, which means GreenFirst has to find a workaround. Rather than waiting for politicians in Washington and Ottawa to fix the border dispute, they are fundamentally re-engineering their customer base.
How so?
They are aggressively pivoting their sales focus inward toward Canada.
Okay, it's like running a restaurant where your main dining room suddenly charges a 45% cover charge.
Right.
So everyone just stops coming in the front door.
Yeah, you lose your walk-in traffic.
Right. So instead of trying to force people through the front door, GreenFirst realized they could just open a drive-through window in the alley, capturing a totally different customer base altogether.
And they actually found the perfect opportunity to pry that drive-through window open. Literally days before this earnings call, a competitor mill in Ontario announced its closure.
Oh, wow. Talk about timing.
Right. And GreenFirst management immediately jumped on this. They are actively working with those newly orphaned customers to capture that domestic market share.
So they're turning a massive political crisis at the border into an aggressive strategy to dominate their own backyard. That's smart.
It's very smart. But, even if they successfully capture more of the Canadian market, the broader North American ecosystem is still really struggling right now.
Right, because the U.S. market isn't just hostile to GreenFirst due to tariffs. The deeper issue is that the global economy, and honestly global conflicts, are actively suppressing the very people who actually buy lumber.
Yes, because, as we know, nobody buys a 2x4 just to look at it.
No, you buy it to build a house.
Exactly. Lumber demand is inextricably tied to U.S. housing starts. Industry participants generally consider a healthy, normalized long-term demand level to be around 1.4 to 1.6 million new housing units a year.
Okay. And where are we at now?
Currently, volume is sitting well below that normal range.
And the main culprit there is interest rates. Long-term mortgage rates have climbed above 6%, which is completely killing housing affordability. People want to buy homes, but they simply cannot afford the monthly payments.
Right, so builders stop building and GreenFirst stops selling lumber.
And at the exact same time, their primary customer base is sidelined by these interest rates. GreenFirst is getting hit on the cost side by inflation. Because forestry operations are incredibly fuel-intensive, aren't they?
Oh, massively. The heavy harvesting equipment in the woods, the fleets of logging trucks, they all require staggering amounts of diesel to run.
And this is where the earnings report gets incredibly specific. It draws a direct line between their local operations in Ontario and global macro forces.
It really does.
They explicitly tie this energy volatility and increased fuel cost to macroeconomic uncertainty and geopolitical tensions in the Middle East. The sources specifically cite the ongoing conflict involving Iran and the United States as a direct driver of this volatility in global energy markets.
And, just to be perfectly clear for you listening, we are strictly relaying the economic drivers exactly as they are cited in the corporate earnings report here.
Yes, absolutely.
We are taking no political stance. We're just examining the cold, hard supply chain impacts detailed in these financial documents.
Right, exactly.
Yeah.
But it is a staggering butterfly effect when you really look at it. Let's map this up based on what we're seeing in the report. A geopolitical conflict escalates in the Middle East. That forces massive international shipping conglomerates to reroute their tankers to avoid certain waters.
Which takes longer and uses more fuel.
Exactly. The longer routes cause global diesel prices to spike. That means it costs twice as much to fill up a logging truck in rural Ontario, which drives up the cost of a 2x4.
Right.
And by the time that piece of wood makes it to a lumberyard in Ohio, a millennial looking to build their first house looks at the price tag, looks at their 6% mortgage pre-approval, and realizes they just can't afford it.
Yeah.
The entire chain stalls out. Everything is terrifyingly connected.
It is, but when everything is that connected, you really have to separate temporary economic pain from permanent structural decline.
That's a good point.
Because amidst all this doom and gloom, the report points out a massive, undeniable silver lining. The United States currently has a massive structural housing deficit.
We just aren't building enough homes for the people who actually need them.
Exactly. Add to that an aging housing stock that requires renovation, and a huge demographic wave of millennials and Gen Z hitting the ages where they want to buy homes. The fundamental long-term demand for homes, and therefore the wood to build them, is absolutely there.
It's just trapped. It's like a massive reservoir of water trapped behind a dam of 6% mortgage rates and high inflation. The pressure is building, but the water can't flow yet.
That's a great way to look at it.
And GreenFirst knows that eventually that dam is going to break. The demand hasn't disappeared, it is just deferred.
Which brings us to the ultimate question. If you are GreenFirst and you're facing 45% tariffs, 6% mortgages, and massive fuel costs, how do you actually keep the lights on while you wait for that housing dam to break?
Right. How do they actually survive this winter?
Well, it requires two distinct tactics. First, securing cash lifelines in the short term. And second, completely reimagining their product in the long term.
Okay, let's start with the short term.
Looking at their short-term liquidity, it is tight. At the end of the quarter, the company only had $6.5 million in cash on hand.
Which, that sounds like a lot of money to a regular person. But for a publicly traded company actively building up its seasonal inventory, $6.5 million is running on fumes.
Total fumes. The seasonal building of log inventory puts a massive strain on their working capital. So to survive this down cycle, they went to the government.
Okay.
They successfully secured a $30 million Canadian loan from the federal government, structured through the BDC, the Business Development Bank of Canada, and the Softwood Lumber Program. And on top of that, the CFO mentioned they are actively pursuing another $10 million from provincial government programs.
Okay, wait, hold on. We were just calling them structurally coiled like a spring a few minutes ago, but let's be real for a second.
Yep.
They just lost $20 million. They only have $6 million in the bank, and their grand survival plan is to take on $40 million in government debt. To a skeptic, that doesn't sound like an elegant pivot. That sounds like a dying company desperately throwing Hail Marys to avoid bankruptcy. I mean, how do we know this isn't just a sinkhole?
That is a completely fair challenge. It really is. And it's important to understand the role of the BDC here. It's a financial institution, wholly owned by the Canadian government, designed specifically to support and stabilize Canadian businesses during economic turbulence.
Right.
But you are right, if GreenFirst was taking on $40 million in debt just to keep running their mills exactly as they always have, hoping the U.S. suddenly dropped tariffs to zero tomorrow, it would absolutely be a sinkhole.
Right, because nothing fundamentally changed.
Exactly. But they aren't just treading water, they are using that short-term liquidity bridge to fund a radical long-term evolution.
And here's where it gets really interesting for you listening. Reading this, it looks like they're actively evolving into a green, energy, and sustainable materials supplier.
Yes, they are.
They are partnering with a company called Texana to build what they call a torrefied pellet plant right there at their Chapleau mill. So let's break that down. What exactly is a torrefied pellet?
Okay, so in a sawmill, when you cut round logs into square boards, you naturally generate a massive amount of waste, right? Sawdust, wood chips, bark, that's all sawmill residue.
Makes sense.
And right now, there is a huge surplus of this residue in Ontario. When we say torrefied, we're basically talking about roasting that wood waste like coffee beans.
Oh, interesting.
Yeah, you bake it in a low oxygen environment through a process called torrefaction. The moisture leaves and the wood chemistry actually changes, making it incredibly energy dense.
So you're basically turning loose sawdust into these tight, hard little energy pellets.
Yes, and they burn incredibly hot and clean. They function almost exactly like coal in a power plant, but obviously without pulling new fossil fuels out of the earth.
And the province of New Brunswick wants this because they're currently trying to replace their coal power plants with green energy for power generation. So GreenFirst is literally taking the waste from their floor and turning it into a green replacement for coal.
It's an incredibly brilliant move, and that is just one initiative.
There's more.
Oh, yeah. The report also details how one of their major wood chip customers, Cap Paper, is currently working with the federal government to build a brand new facility in Canada.
Okay, what for?
This facility would produce entirely new alternative building materials. So by securing that relationship with Cap Paper, GreenFirst guarantees a long-term local Canadian demand for their sawmill residue that has absolutely nothing to do with U.S. housing starts or cross-border tariffs.
Wow. So you take on the debt to survive the winter, but you spend that winter building an entirely new revenue stream that bypasses the U.S. border entirely.
Exactly.
Because you aren't a victim of a 45% tariff if you're selling coffee roasted sawdust to a Canadian power plant.
You have to keep the payroll going in the short term. But in the long term, true resilience requires evolution. You can't control mortgage rates, and you definitely can't control international trade wars.
Right.
But you can control what you do with the resources you have. By turning a byproduct, something traditionally viewed as waste, into the fuel that replaces coal, they are fundamentally detaching a portion of their revenue from the boom and bust cycle of the housing market.
So bringing this all together for you listening, we started this journey looking at what appeared to be a fairly depressing, dry financial update. Just a $20 million quarterly loss from a Canadian forestry company.
Right, the surface level.
But by decoding the transcript, we uncovered a literal masterclass in corporate resilience. We saw how they are navigating extreme logistical nightmares, pivoting aggressively away from a staggering 45% international tariff by opening a drive-through to their domestic market, and bridging the gap of global inflation by turning their waste into green energy solutions.
And really, the next time you see a dry earnings headline scroll across your newsfeed, remember this deep dive. You'll know how to read between the lines, look past the basic profit and loss numbers, and find the actual pulse of the global economy hidden right there in the operational details.
Exactly. And it leaves us with one final fascinating thread to pull on. We just saw how a highly traditional localized industry like Canadian softwood lumber is fundamentally pivoting its business model toward green energy power generation, simply to survive geopolitical and macroeconomic pressures.
It's quite the leap.
It makes you wonder, what other boring traditional industries are quietly undergoing massive forced evolutions right under our noses, just waiting to be discovered in their quarterly reports?